This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. I know that here on the show, we talk a lot about the importance of bank partnerships when it comes to the success of any type of embedded finance or fintech endeavor. So let me tell you about a provider that is raising the bar in embedded finance. Built by Fifth Third Bank, Newline enables enterprises to launch and scale payment products using their API-first platform, enabling embedded solutions that scale responsibly. Learn more about Newline by visiting newline53.com. Hello, and welcome back to Bank Nerd Corner. My name is Alex Johnson. I'm the creator of Fintech Takes, and I am thrilled to be joined as always by the banking and fintech editor at Bank Director and my friend Kiah Hazlitt. Hello, Kiah.
Hey, Alex, how are you?
I am doing okay. How are you?
I'm good. We are recording the day after the election, so vibes are weird. But how was Money 2020?
You know, it was good. You missed it because you were doing crazy Kiah globetrotting adventure stuff. But for those of us who decided to work that week, Kiah Hazlitt, I had a very busy week. We're going to probably talk about some of the stuff that I got to learn and experience at Money 2020 during the show. But suffice it to say, very productive. We also did the basketball tournament, and there were no twisted ankles or blown out ACLs or anything, despite us all being old and out of shape. So,
oh, that's awesome.
Yeah, it was a win all around, really.
Well, and we are, after not seeing each other in person for about 2 years, we are now seeing each other twice in 2 years, in 1 year.
Yes.
Coming up in a couple of weeks, we'll both be in Washington, D.C. for AFC's Policy Summit and actually speaking on the same panel.
Yes, I think you're moderating that one. I always think it's really funny when one of us gets asked to moderate it because we have a different webinar that's coming up actually the week that this podcast drops. And I'm moderating that, but I feel like whenever I'm moderating something or you're moderating something, the other person is just going to grab the mic and help co-moderate it.
No, I'm a very good panel participant. I am the best panel participant.
Are you?
And that is why I was asked to be on the panel, because I follow all of the rules and I only talk when it's my turn.
Well, that's very fair. I'll try to reciprocate that experience. And we also have another moderator of a panel at the AFC Policy Summit joining us today for Bank Nerd Corner. Kiah, do you want to do the honors of introducing our guest?
Yeah. So coming in for maybe an AFC Policy Summit preview, Bank Nerd preview, is Bloomberg Law's banking, fintech, and regulatory correspondent, Evan Weinberger. Hi, Evan.
Hi, how's it going?
Good. How are you?
I'm doing good. Thanks for having me today.
We are delighted to have you on the show. I think we've talked about a ton of your reporting on the show over the last year.
I know we've talked
about
you, but we haven't had you on the show to talk about your reporting.
Yeah. It feels weird talking about your work, but never having had you on. So we're delighted to have you on. Again, as Kiah mentioned, day after the election, the vibes are strange and no one really knows exactly what's going to happen next. So we're just going to plunge into that uncertainty. We had a long list of topics, Evan, given your sort of ability to jump across, I feel like any topic in that bank, fintech, policy Venn diagram. But we selected a couple of stories that we're going to talk through. And then because I'm forcing Kiah and Evan to play my game, we have a special thing at the end that we'll do. So with that, Kiah, would you like to introduce our first story?
Sure. So earlier, last week, the comment period on the bank fintech request for information for the prudential bank regulators closed. And so we got to see basically all the facets of this space weigh in. And Evan wrote an article about it. I took a peek at some of the bank letters, and I made Alex look at the fintech letters because sometimes they melt my brain a little bit. But I thought it was interesting to kind of get take the temperature and see all the different perspectives that were represented there. So Evan, what did you see in your reporting on this?
What I saw, first off, that is a genre of article I like to do called Evan Reads Comment Letters, so you don't have to.
Nice.
So it's a lot of fun.
It's a real public service.
It really is. What I saw, and it's something that I know is near and dear to both of your hearts, is that the banks and the consumer advocates both came out and said, you have all the authority you need to police these fintechs using the Bank Service Company Act.
I've heard of that.
Yes.
So
Did they cite us? Okay, did you check the citations?
I did not see you guys.
Oh no!
I feel like what happens is we take other people's wonderful work, and Kiah and I have had some folks on the podcast in the past who've written articles about the BSCA, and we amplify it, but then we're the missing citations. So I feel like we do deserve a little credit, Kiah, for helping make the BSCA sexy. So Evan, it was mentioned in multiple places, it sounds like.
It was. The Bank Policy Institute and the Clearinghouse mentioned it. The Consumer Federation of America mentioned it. It just reminded me of the scene in Ghostbusters where Peter Venkman tells the mayor, dogs and cats living together, mass hysteria. Everybody was talking about the Bank Service Company Act.
And so was the mentions that the BSCA provides regulators with the authority to oversee these fintechs because these fintechs are bank service companies?
Yeah, essentially.
Wow. We did it. We solved it. We figured out both what is a bank service company and how to use the law. So
the thing I think is really funny about it, and I'm so glad that everyone is now talking about it. This really does bring joy to my heart. But we're still in the process of having T-shirts made to celebrate this influence campaign. But the thing I maybe would kick back to you, Evan and Kiah, I'd like your take on this too, is having spoken to a number of different regulators or heard them discuss stuff that's happening recently, I haven't really gotten the sense that they're on board with using this power that we all think that they have. Evan, do you have any sense of if the BSCA is actually going to be a tool that gets pulled out of the toolkit more, or are regulators reluctant to use it for some reason?
Well, I'm not sure. I mean, part of it is just person power issue at a lot of these regulators. There just aren't that many examiners, and they're stretched very thin. So asking them to do even more when there are already questions about oversight of anti-money laundering and other sorts of things, I'm not sure how excited they are to sort of add more to the plate. Also, I'm not, given the events yesterday, we have to think, there's a whole new equation of whether, the new leadership at the FDIC, let's say that Vice Chairman Travis Hill gets promoted to chairman of the FDIC in January. Or there's another fun ousting of an FDIC chairperson, or departure of an FDIC chairperson, as there was at the beginning of the Biden administration. I don't know what he thinks about it. And I think that's a really important question that we're going to have to get to on a lot of issues along these lines, because Marty Gruenberg might not think that, but maybe Travis Hill does. I don't know. We'd have to, explore it a little bit with him.
Well, and the other thing too to think about is, Jim Bergen has talked about how there's no implementing role for the BSCA. So we would actually need to see some rulemaking from different bank regulators around how they will do this, and training of the supervisors about how they will do this. The other thing that I've been told is that the BSCA currently is more of an IT type exam, and I do not believe these comment letters are imploring bank regulators to do IT exams on the fintechs. They want more of a safety and soundness. It sounds maybe more of an audit type exam. And so, the BSCA isn't coming to save us, in part because, there's just it's so vague right now that everyone can put their desires of what it could be or its powers into the vacuum or the black hole of the BSCA, but without more specific information from the regulators about how they would use this power or this role or this law. It's, I was surprised to see the mentions. I was surprised to see everyone feels like there's consensus around what a bank service company is and what these companies should be examined for, but I still think the law itself needs to be fleshed out a little bit more.
Yeah, I mean, the only other thing I would add to that is just to your point, like it's kind of a Rorschach test for like, yeah, when I look at this inkblot, I see fintechs no longer posing a liability problem to me, or whatever it is, right? Like I feel like there is this sort of ability to stamp your own desires onto it. But to Evan's point, at the end of the day, I think one of the things we're running up against in the US is we just have a ton of fintech companies and there's just not enough bodies to supervise them all, right? And we're going to talk a little bit later about 1033 and open banking, but the same general issue appears there too, which is banks asking, how do we know which of these companies that are getting authorization from consumers we should trust to give the data to and that the data will be safe? And can you give us like a list of the good ones and a list of the bad ones? And have they all been, audited? And do we know anything about them? And someone has to do that auditing work, both for bank fintech partnerships and for open banking and other sort of requirements. And it's not clear. No one wants to do that. No one wants to sign up for that work. So I do think that there is just general operational challenge around this question of supervising fintechs. Kiah, I don't want to trigger another rant by talking about fintechs supervising themselves, although that may come up in a minute. But I want to kick it back to you because you read a big bank comment letter to the agencies with some interest. Can you tell us about that one?
Yeah, so like I said, I read all of the bank letters. Some of them were probably more of the vein that wouldn't surprise you, or they are some of the biggest BaaS partners. One letter that did stand out to me was PNC's letter. And I was surprised to see that PNC believes itself as having a perspective to share with regulators. The letter stands out to me because of its tone. I can't tell if PNC is angry at bank fintech partnerships. I can't tell if they're being strategic and see that if regulators crack down on these partnerships, PNC can maybe pick up some business. But I encourage everyone to go look at the letter and give me their read of it. Some things I wanted to highlight about this letter specifically are a theme that I'm seeing, which is supervision by activity. So not like right now in the United States, we bank regulators supervise the charter holders of these the institutions. So if you hold a bank charter, you are supervised by a bank regulator. Now, there is some discussion, I've seen it from Governor Bowman. FSOC uses this idea in some situations, which is supervision by activity. So if you do an activity that is seen as risky, then you receive supervision, and you can decide whether you want to be in that activity and doing it or not, but it is not about the charter. And Todd Phillips talked about this too. Alex, I don't know if you remember, but he was talking about the non-bank crypto companies that take deposits and do maturity transformation. So PNC is specifically worried about deposit-taking partnerships. So fintechs where they take a deposit and place it at the bank. They argue that there is no way for the fintech or the bank to explain this to consumers in a way that mitigates and addresses the risk of who holds the deposit. They also argue that these are BSCAs or BSCs because the fintechs perform authorized services for the partner bank, including record keeping and access to records, user onboarding, compliance management, transaction monitoring, and compliance handling. And I think that's an interesting articulation of why a deposit-taking fintech qualifies as a bank service company. They also point out that the OCC has regulations that third parties must agree to OCC supervision if they receive a non-controlling investment from an OCC regulated bank, so that there is precedent for this, which I think is interesting. I don't know, how that supervision works out, but there is precedent here. They also, again, I think that there's some anger, some bad feelings in this letter because they shade strongly the incentives that drive these fintechs. They say fintechs are high risk by nature. They fail even when they're backed by VC funding at a rate that would be unacceptable to regulated banks. This means that they are encouraged by other investors to take big risks in search of outsized returns. Because fintechs, unlike banks, do not receive management or supervisory rating, they have little incentive to adopt the risk management practices that banks must. And unlike banks, they suffer no regulatory penalty for forsaking compliance and risk management or for otherwise taking their outsized risk, so long as it does not violate the law, which I think is pretty strong language, and says that maybe they also are a little skeptical of some of the standards that would be strong enough to change behavior and incentives. And then finally, as if this is not enough fire in a comment letter, they argue that we should get rid of the Durbin interchange cap because this creates the strongest incentive for community banks to partner with this. They argue that this is a form of regulatory arbitrage. And that while some of these banks are, best in class and have committed themselves fully to banking as a service, many of them do not have appropriate compliance. They also kind of point out, and again, this is like some of the shade, that some of these banks do not have the technical expertise to do banking as a service, and in fact needed the middleware companies that are creating so many regulatory problems for them. And so that need to partner with a third-party middleware indicates that these banks are not sophisticated enough to really be running the program like themselves anyway. So I thought that was really interesting. And like I said, I encourage everyone to read it and go check it out for themselves because they're making some really, really big arguments here.
Yeah, and on interchange, PNC might get their wish on the Durbin Amendment, but not in the way that they want, because there is litigation in Wyoming that is looking to eliminate, the Fed's rules for the Durbin Amendment altogether.
Yeah, you really got to be careful what you wish for with Durbin, because I feel like that it could go higher, but it could go lower.
This is the monkey's paw situation, because I'll get on my horse now and say that the corner post decision from the Supreme Court last term is going to, in the end, be a little bit more impactful for banks than the Loper Bright decision on Chevron.
Explain corner post for those who don't know.
Corner post basically says that if you are a company that is new to an industry or new to a market, and there were rules that were put in place before you were in existence, you can challenge them if you think that they're unfair to you. I know, Kiah, you are a soccer ref, so this is somebody coming in and challenging the rules that have existed for a long time. And it's not like the banks love Durbin, but the banks now have asked to come and defend Durbin in that litigation.
Wow. So the
BPI was like, we don't like Durbin, but we don't want it to go like lower, right? Or whatever, lower, I can't remember which way the banks don't want it to go, but the BPI has had to come in and defend Durbin. Yeah.
The banks are afraid that the Fed is going to make the cap. The Fed is proposing to make the cap lower currently, and their BPI is just like, well, we just don't want. Yeah, man. Part of it is just we don't want rules that exist to go away like this that we've been complying with for a long time, because it's a giant pain.
Yeah.
Right.
Can I just say that in 2018, when the big Trump tax cut went through, if we're thinking about a second Trump administration, I'm really surprised that the banks did not put Durbin back in that bill. I'm surprised there wasn't more fighting at that time over Durbin, and they did not, because that was kind of the big one banking bill.
Well, the Durbin thing is interesting to me, and it kind of ties into the overarching comment from PNC, which is it's funny. I don't really disagree with anything that they had in the letter that you talked through, Kiah, right? It's okay,
yeah, there are some good points.
Yeah, Durbin is kind of a scam. It creates an opportunity for regulatory arbitrage. The money just goes in big merchants' pockets. It doesn't flow to consumers. Yeah, okay, I buy that. The argument that small banks that get into banking as a service, a lot of them have no idea what they're doing, and that's created all kinds of harm. Buy it. I think that makes sense. The argument that functionally these fintech companies are acting as banks, but without direct supervision and should be supervised more directly, again, through the BSCA, which regulators don't want to do because they don't have the bodies to throw at it. Fair, totally fair, right? There are these shadow banks that are out there. So as you were talking through it, my natural fintech brain was like, be prepared to be mad or disagree with things Kiah's about to say that PNC wrote in their letter. And all of those seem pretty fair. The thing I'm stuck with, though, the sort of counterposing view on it is, those are all true statements, but I don't think they're really being argued from a good faith position, right? And this ties into other things PNC is doing, but it's like, you mentioned this at the beginning. What's PNC's interest here, right?
Yeah.
Like, they don't do bank fintech partnerships, really. They don't do banking as a service. They don't do embedded finance. Like, they want to stop fintechs from encroaching on their territory, which is why they're weighing in here. And so it's not a very pro-market, pro-consumer, pro-competition point of view, but the points they're making are all individually fairly valid, it feels like.
This is definitely a Kiah paraphrase, but it's like, in conclusion, kill fintech partnerships with banks. Like,
right.
I actually think, sometimes I have to resist drawing that conclusion too. In a free market, I think that some stuff should be allowed to fail. And if an industry can't kind of manage itself, it shouldn't really be allowed to exist, I guess. But the fact that PNC is making this argument directly to regulators in a public forum, and that actually, that's not the craziest conclusion. They lay out, I think, very compelling arguments that the fintech industry and that the community bank BaaS space is going to have to really grapple with in order to avoid the conclusion that PNC is going for, including things like Durbin, but also PNC's regulate this activity and kind of regulate it out of existence.
Well, and they have a point, right? Like, Synapse happened, consumers haven't been able to get access to their funds. Like, it's not like they're making an argument at a time where what do you mean? Like, how could anything just go wrong? They have a very recent set of facts to sort of draw on. Evan, what's your take on kind of PNC's position here?
I think I agree with what you guys said. I just wanted to give a shout out to Coastal Community Bank for their letter, which was basically like, we're not all Evolve. We do all of this stuff ourselves, and we're very good at it.
And they are.
I mean, a reasonable thing for them to say. And they laid it all out. I think that's right. I think, this kind of, we'll get into this in a little bit later, but I think, a lot of these banks, there's a lot of, I don't know, it sort of feels like the big banks are starting to gang up on the little banks in a way that we might not have seen in the past, or if we haven't seen in the past, it has been a little bit less.
Yeah, there's definitely more opportunities for them to be divided. Normally they are kind of on the same side, or the small banks see themselves as having the similar interests as the bigger banks, right? Like, when we think about capital rules, when we think about regulatory scrutiny, the small banks believe that the regulation will trickle down, so their interests are more closer aligned. They're not always aligned, obviously, in M&A and stuff like that. It's not doesn't always pan out. But here, I think here and in open banking, there might be more division.
Yeah, I definitely think there is.
You read the fintech comment letters, which I made you do.
You did.
What was the vibe there?
It was different than PNC, as you might imagine. The vibe generally was, we're very happy that you're doing this. We would like you to do it in a thoughtful way that is nuanced and that doesn't harm the pro-consumer, pro-competition innovations that fintech has introduced to the market. I would say that was the general vibe. I would say that their starting place for making that argument is also grounded in the fact that fintech has kind of melted down recently. And so they couldn't go, what are you talking about? Things are going great. So they had to take more of a, I guess, slightly contrite perspective to start, but they were definitely arguing for, we don't want to kill this thing. We want to regulate these partnerships in a way that will allow them to thrive and allow them to continue to flourish. So the comment letter that I spent the most time parsing, as you might not be shocked to hear, is Mercury, which...
Why did you pick Mercury?
Well, as you might know, if you read my newsletter or you follow Kiah on Twitter or you read Jason Mikula or you read Evan, Mercury has definitely had some challenges recently as it relates to compliance. They have staffed up significantly their compliance. In fact, they said in their letter that Mercury has heavily invested in our risk and compliance functions, which make up nearly 1/4 of our total employee count. Mercury teams across customer service, partnerships, operations, engineering, product compliance, and legal, as well as our senior leadership, are in constant communication with our bank counterparts. So everything is good now, I guess.
Fixed it.
Yeah, they definitely fixed it. They say, kind of to the point about small banks, that fintechs like Mercury offer a path for smaller regional banks to stay competitive amid banking consolidation. Through mutually beneficial partnerships, fintechs help partner banks grow their deposit base, introduce more revenue streams, expand access to financial services, and modernize their overall business through responsible innovation. You don't say. So they had some framing that they were doing in the letter to sort of position these partnerships as both critical for community banks, as well as something that is today grounded in a very serious focus on compliance. Ignore the fact that many of the very qualified people who now work at Mercury in compliance or legal functions only joined like 6 months ago. And before that, I think you could make the very reasonable argument that there was less of a focus on compliance than there is today. But, credit for, I guess, catching up to the market eventually. They had several pieces of specific feedback for the prudential regulators around these partnerships. So I wanted to talk through these real quick. The first one, which is one I actually agree with, is we need to find a way to facilitate the sharing of confidential supervisory information to fintech companies. So this is something I've heard not just from Mercury, but from other, shall we say, more serious ones.
Good luck getting that from regulators.
It's tough, right? It's really tough because obviously, confidential supervisory information is confidential for a reason. They take it very, very seriously. The point that
it's a crime, it's a crime to share.
Legitimately,
it's
like you
not
cannot do it.
Yeah.
You can't.
They might have to change laws around.
Right. And the Mercury talked a little bit about potential mechanisms they would have for doing that. They talked about the Freedom of Information Act requests, and they got into the legal side of the argument a bit. But the crux of it is, it makes it really difficult for banks and fintech companies to manage risks when the banks can't tell the fintech companies why they need them to make changes. And I think that's a fair point. And so I do think, to your point, Kiah, there are some very specific rules and laws in place that govern this. So it might not be easy to change, but I think they make a fair point about we need a different way of communicating this information, because unlike a traditional vendor relationship where you can just tell FIS this needs to change, or in FIS's case, they're supervised under the BSCA, so maybe they're hearing this directly, that's a different thing. But in this particular case, it's a little bit more challenging. The example that they actually gave in the comment letter was exceptions that are made for example, if McKinsey is helping Bank of America to draft its living will, which was a thing that was required after the financial crisis, that's something that they need outside expertise for. It requires access to a lot of confidential information, but there's an exception carved out for it. So there are, I think, mechanisms to carve out the ability to share some of this stuff. And fintech companies make the argument that they need it in order to do their jobs better without just harming their products or harming the end customer. So I thought that was interesting. They also talked about the need for specially trained supervisory staff that's familiar with fintech. Again, this kind of goes to our core thing we keep hammering on, which is just there's not enough bodies that know this stuff and that can be thrown at this stuff. But to whatever degree it's possible, they're arguing for we need more specialization. We've seen the Fed novel supervision team and other groups at the prudential regulators sort of form to do that. So I do think directionally that's a place that the industry is already headed. They talked, Kiah, about more collaboration between industry and regulators. They talked about innovation labs. They talked about advisory groups. They briefly talked about a national fintech charter, which, having dug into that topic, is not going to happen. But they
Did they cite you? Did they cite you right here?
No, they didn't cite me. I just need to give up the ghost on being cited. That's fine. They're just never going to be cited in these letters. They talked about industry standards, and specifically our friends at CFES, which they are a founding member of. So they talked about the importance of fintech supervising and regulating itself to a degree, and how serious they were about that. And then my favorite part, if I might just diverge on one for just 1 second, is they talked about the risks of intermediate platforms. So these are the units and Syncteras and Treasury Primes and Synapses of the world. And they talked about the challenges that those platforms pose. And if you'll indulge me, I just have to read this quote. Mercury has had some direct experience with intermediate platform providers. We initially launched our product in 2019 with such a partner, Synapse, they don't mention them by name, but that's who it was, which allowed us to get to market quickly. And we are aware of many small, innovative fintechs that have relied on intermediate provider model to initially get to market. But the model proved unworkable for Mercury as we scaled. With the benefit of scale in 2021, we began to work to launch direct connections with separate bank partner, and that model proved beneficial for many of the reasons outlined here. Having multiple independent bank partners with strong direct relationships with each of them has become an important part of Mercury's strategy. As we developed our multi-bank direct engagement model, it has also become increasingly clear that our intermediate platform provider was not operating excellently in certain key areas, including compliance, cementing our preference for and belief in direct bank relationships. And I just have to say that that's fine, but according to the reporting from Jason Mikula, The Information, and elsewhere, Synapse was actually trying to stop Mercury from doing things that would have been out of compliance. And it was Mercury that went around their intermediate platform provider, Synapse, directly to their partner bank, Evolve, in order to get Evolve to sign off on things that they shouldn't have signed off on. So, while I am not a huge fan of the intermediate platform provider model, I find Mercury's argument here to be deeply disingenuous. And I just had to share that before I have a stroke. So it feels good getting it off my chest.
But there were other fintechs who made similar arguments. I believe it was Stripe's letter had something similar in there of like, hey, you pay more attention to those intermediate companies, but these direct partnerships are not.
The direct ones are fine.
Yeah,
well, it's exactly. Like the thing that's so annoying about it is I think there was very little discussion in any of the comment letters I saw, and I'm still working my way through some of them. But the ones I saw, no one talked about the fact that like the reality is it's the bank on the other end that matters, right? Like the Synapse thing, they went out and got bank partners that would allow their clients, the fintech companies, to do whatever they wanted. Stripe partnered directly with Evolve in order to do a bunch of this stuff. Didn't make that any better either. And so I think the fact that they're sort of trying, I guess, to pin the blame on everything that's happened on the intermediate platform providers, I just find that argument to be disingenuous. And again, I'm not defending the intermediate platform model. I think there's all kinds of inherent conflicts with it, but it does seem like the large fintech companies that submitted comment letters were like, yeah, if it weren't for those pesky intermediate platforms, everything would have been fine. And it's like, that just doesn't jive with the reporting that we've seen.
It just needs to be said, and I promise I'm going to try not to rant about this. Knock on wood. Mercury's bank partners are under a consent order. And this is not how I would want my fintech partner to talk about its business to the regulators while I, the bank, am under a consent order. I will be under this consent order for years. I am about to pay millions of dollars to do lookbacks. And I might not be on the middleware platform that my fintech partner was on. And now we're direct and we're like fixing everything. But this is not the tone that I think a very close partner of mine should be taking to my regulators, right? Like Mercury doesn't have a regulator. Mercury is talking to the regulators that gave First Choice and Evolve consent orders. And like, I sometimes joke like saying nothing is an option. This would have been, I think, a really, really good time for Mercury to say nothing because the fact, I mean, you mentioned public reporting around this, but the facts are, it's not clear. Mercury doesn't probably say in its consent order how it's helping its banks manage their compliance responsibilities, how it's paying for the lookbacks, how it's
it's comment letter.
It's
yeah.
just
No,
not. It's just not. And the banks themselves didn't turn in comment letters. I don't think, and sorry, I did this work last week. I don't think any bank BAS bank that's under a consent order turned in a comment letter. It's not appropriate for those banks to be weighing in, right? Those banks are in the penalty area and are probably under they're saying nothing about consent orders. That's the whole thing about being a reporter. You can't really talk to these banks anymore because they're being quiet on purpose because they know to be quiet.
They also can speak to their trade groups. That, it's not so much being silent. It's just like, hey, trade group that I'm a member of, can you say this to the regulators so that we don't have to? That's the other option. That's what most of them do.
Yeah, no, I mean, that's exactly right. And I will say, just to put a capper on this, that well, again, they were sort of presenting themselves as this is who we are today. We've staffed up all these compliance things. We have these direct bank relationships. We take this very seriously. It was Ahmad, the CEO, who signed the comment letter, right? And it's like, you were there from the very beginning, right? Like it's not like you can go, oh yeah, that was the old CEO, that was the old leadership. Like we're totally different
new leadership,
now.
new company.
Yeah. Right. It's like, no, like you brought in new staff to help in some of these areas, but like you were the one who signed off on those decisions. And yeah, Kiah, I think to your point, there is a almost like an etiquette to these things that exists, and fintech doesn't seem to know about that part of it. So I do think that is a very fair hit. Any last quick takes on like what might come out of this RFI process, Evan? Any like sense of like where this is going to go from here?
Again, it all we have to see what the new leadership is going to do. But one thing that you mentioned in the Mercury letter, and I saw it elsewhere, asking for more, more of the innovation lab being more welcoming place at the FDIC and sandboxes and things like that. That's not something the Biden administration regulators want to do, but it would not shock me if that's something that we see coming out of the Trump administration's regulators. I mean, because the Trump administration's regulators did that in the past. So,
right. No, that makes sense. All right. Can I jump us to another topic that is closely related to many of the things we've been discussing?
Go for it.
All right. This is our favorite rule, the CFPB's Personal Financial Data Rights Rule. I've spent a ton of time on this. I actually, Kiah, tying back to Money 2020, got the opportunity to interview Director Chopra on stage at Money 2020 and talk about this, which was a fascinating experience. Very fun. He was very candid, perhaps because of the election and, things are all going to be different now. So might as well just sort of, all say what we feel. So it was a very candid conversation. We didn't get into everything because the rule is 594 pages. But just to sort of quickly summarize what's been happening, the final rule is pretty similar, I would say, in broad strokes to the proposed rule. So not a ton changed, despite the Bureau getting a tremendous number of comment letters and input from industry. I would say the two big things that changed, and there are lots of other smaller things, but the two big ones are they extended the compliance deadlines for the rule. So before, the earliest compliance deadline would have been 6 months from the rule being finalized. That got pushed out to about a year. So I believe the first deadline is April 1st of 2026, and then progressively longer timelines for smaller banks and non-bank data providers. And then they also made some mild concessions, I would say, on the ability for data recipients to use the data for secondary purposes. So the original proposed rule was incredibly strict in restricting any secondary use of the data. I think Director Chopra's perspective on that is that in the absence of a national data privacy law in the US, they had to sort of build more stringent privacy protections into this rule to make sure that it wasn't abused. It got a tremendous amount of pushback from industry, not just from fintechs and data aggregators, but from policy groups, consumer advocates. Like everyone was like, this is a little too much. I actually was surprised at how little ground the CFPB gave in the final rule as it relates to secondary use. They carved out some exceptions for if you need the data to comply with a law enforcement request like a subpoena, if you are going to use it to stop fraud or stop scams, it can be used that way. And then if you're going to use it to improve the product or service that the consumer authorized you to use, you can do that. But there's a whole bunch of other things like cross-sell, marketing, research and product development that were all no. The Bureau is not even allowing you to use the data if it's been de-identified or anonymized, which is kind of interesting to me. So rule stays mostly the same. The other big thing that happened, and I'd love for your guys' comments on this, is that the Bank Policy Institute sued the CFPB over the rule. I asked Chopra about this on stage. He joked that he had not read their lawsuit yet, and he didn't think that they had taken the time to read the final rule either, because the lawsuit was filed shortly after the rule was finalized. So clearly this was something in the works. I can say that I think both the Bureau and particularly fintechs and data aggregators who are working with the banks on standards were pretty surprised by the lawsuit. So it wasn't something that they knew was coming for a long time. And the general argument, and this is where, I'd like both of you to weigh in on it, is that the final rule will put consumers' financial data in danger and will lead to a massive increase in fraud and scams. And so the comments from the BPI and from some of the big banks like Chase is that this isn't open banking, this is open season for fraud and scams.
I didn't realize they were so concerned about scams. I thought banks had no responsibility when customers give their information away. And so because Reg Z doesn't apply, or Reg E doesn't apply. So I'm so concerned. I'm so interested that they're very passionate about it as it applies here.
I was surprised by that too.
I think one very, very important thing that you should consider when you're discussing this lawsuit is that at the very end, I cover a lot of litigation. So you look at the prayer for relief at the very end, and that's what they're seeking.
Yep.
There's 8, I think, specific things there are 8 items in the prayer for relief. Most of them are just put a stop to the rule, put a hold on the compliance dates. The only very, very specific ask is allow banks to charge for access to this data.
Yes. Yeah, and that was something that came up in all of the comment letters as well. Mm-hmm. And it's kind of an interesting philosophical question, right? Because the Bureau didn't budge on it, right? They heard that feedback from industry. They're absolutely under no circumstances are banks allowed to charge for this data. And I don't know. I find the sort of policy argument interesting.
Can I charge for the data? Wait. Can I? It's my data, right?
You can't.
Oh, I can't charge. I can't charge anyone for my data.
No.
I don't want to say a uniform, universal, but for the most part, they already don't charge for access to this data in the contracts that they sign with the data aggregators.
They do not. Well, and it's to your point, Kiah, consumers aren't getting compensated, even though it is ultimately their data. I think the shade of the argument that I kind of get a little bit, although I still find it somewhat disingenuous, is it's going to cost us money as the bank to stand up this service and to have a developer portal and API ready to maintain it. That's all a cost to us, and we can't recoup that cost. I tend to find that argument not that persuasive, and I think the thing I come down on with this is the data is exhaust off of your business that has nothing to do with the data, right? You're a bank, you have a privileged, regulatorily approved position in the market to do this thing and make money in this way. The data is exhaust off of that. It's not something that you get to monetize. And I think as a general principle, that sounds right to me. It's interesting though, because the two things that this is going to run into are one, Chase already launched an advertising business based on its own first-party data. So it's finding ways to monetize its data. This just means that they can't monetize it directly when the consumer authorizes it to be shared. So the data exhaust monetization thing is going to happen just in ways that the rule can't govern. So that's one thing. And then the other thing is while banks haven't historically charged for this, as the rule potentially expands in the future, and again, we'll see what happens under a Trump administration, maybe the rule gets changed or rolled back or frozen in some way, but assuming directionally that open banking continues to make forward progress, eventually this is going to have in scope like payroll data, and then you're going into a whole new world because payroll providers do charge for this data today, right? Like if you're a payroll API company, you pay to access like ADP's data, and ADP makes money off of it. And there's even the argument that maybe employers should be compensated for the data that's in the payroll system. So as this rule expands or the scope kind of broadens over time, this concept of you can't charge for the data might become interesting. So I think that's kind of fascinating as well.
One thing that I think about we think about how the agencies might change and how the proposed rules at the end of the Biden administration may alter or go away, is like the direction of things. And so sometimes these lawsuits are kind of annoying to me, not because, they don't have like arguments to make or whatever, but because I think they're just really confusing to players in the market. And I think about how, it's a lot of work to comply with rules, and the message of should I bother complying with 1033? Should I bother trying to comply with 1077 or 1071? Should I bother learning what of my deposits come through intermediaries that might be designated as brokered? Should I bother with the reconciliation rule from the FDIC? Because they might go away, they might be challenged, they might be changed. And I just want institutions to think like in the future, what should the financial system look like? And what can we get there by practice, by market, and what do we get there by regulation? Open banking is already practiced in the United States. And so I think these lawsuits are confusing to some banks when they're not a co-signer of the BPI lawsuit because they don't know what they should be doing right now. Should they continue making investments? Should they continue to come up with a data strategy that would think about, going on offense under an open banking regime? Or should they just do nothing? And I think one of the issues is a lot of banks might do nothing, and long term that would be bad for them, even if the BPI lawsuit wins, right? I think it would be bad if banks are not investing in this like future economy where data is used this way and customers can use data this way.
Just to add on to that, one other really important thing that the CFPB did in the final rule that wasn't in the proposal was exempt all banks and credit unions under $850 million from the rule. I didn't sit down with Director Chopra on stage, but I sat with him after the rule was announced in a conference room. And I asked, are you kind of setting up a bifurcated banking system here? And he said, no. First off, even the banks that are, above 850 million, and I forgot the exact cutoff point, but they have until 2030 to comply.
It's a long time, yeah.
So it's a long time. And he said, by that time, even these small banks, there should be product offerings out there that they'll be able to get on board because their customers want this. I think directionally he's probably right, but that is kind of a big leap. Because we know how the cores operate.
The other thing too is like maybe under the Trump regime, we're going to get like a lot more de novos, but the current rate of de novo activity and M&A activity indicates that in the future there will be fewer banks and they will all be bigger. That is just how growth works. And so if you are planning on being 850 million in 2030, I guess long term, that's build around that vision. Most banks, I don't think, want to be 850 million in the year 2030.
The rule allows for some wiggle room there in that it's based on a Small Business Administration definition of a small business. So I don't remember exactly how that works because your typical small business is not $850 million. But for banks,
typically, and I think to your point about de novos, Kiah, any new person who's starting a bank would start from the perspective of we want to be able to support open banking because competitively we have to.
Good luck, it's kind of also.
Right. We're going to start a new bank, but we're going to start it like it's 1984. That would be a very strange approach to take. Yeah. So I think that's a good point. And then just to put a capper on this, the other thing is to your point about competition, and it goes back to PNC's comment letter on bank fintech arrangements. big banks definitely want to have their cake and eat it too, right? And so it's like, we would like to stop this rule because there are things about it that are annoying to us or will be problematic to us. And there are some legitimate gripes, right? Again, like that risk management component is really tricky. The rule doesn't really specify any universal principle for like where liability should sit when there's a data breach or consumer harm. So there are some legitimate gripes that banks have. But when I look at like a Chase or I look at a PNC, and actually Bill Demchek, the CEO of PNC, has talked about this on the record, like they view open banking as a way that they can pull deposits out of smaller banks that can't compete on open banking. And so if you look at this rule, like Chase already has pay by bank, right? Like they're doing pay by bank for very large merchants that they have a larger commercial banking relationship today because those commercial clients demand it. So they're going to continue to benefit from open banking. They're going to do cash flow underwriting. They're going to use open banking to better manage like fraud. Like they're going to take advantage of all the benefits of it. And to your point, if they freeze the rest of the market, the competitive advantage I have as a Chase or a PNC is I'm light years ahead of all of these smaller banks on open banking, and it creates an unlevel playing field. And so I think that is a very fair concern with the BPI lawsuit. I would echo your comment about, regardless of what happens with the lawsuit, regardless of what happens under the Trump administration, like you have to keep treating open banking as if it's a thing that customers want, because it is, and as a competitive necessity, because it is, because your larger competitors, regardless of what they say in a lawsuit, are still going to be taking advantage of this technology. So I think that's a very fair point.
And before we move on from open banking, can I just mention my favorite part of the BPI lawsuit?
I'd love that.
It was filed so fast that the first, I don't remember how many references they made. They just refer to the proposal.
Do they really?
Yes.
Okay.
Oh no.
There are a few mentions at the end.
Honestly, why not wait a day? Like, why not wait like a week? Like, what is to be gained by filing it that fast? It is such an obvious critique that you could just sit on it like for like 48 hours and then just submit it and then do a Control F.
Just copy replace. I was going to say, yeah, exactly.
Yeah.
Now I had talked to some trade group heads about that, and they mentioned that was
a little cringy there,
a little crazy.
Yeah. Again, etiquette. There's an etiquette for how these things are supposed to work. I get a lot of questions about what you should look for when choosing a fintech partner bank. And at the top of that list are security, compliance, and operational resilience. As you know, I'm a huge advocate of building and scaling products responsibly. Nothing grinds my gears more than when companies move fast and break things. With Newline by Fifth Third, you don't have to sacrifice anything. You get the innovation of a modern developer platform with the stability and compliance competency of a leading bank. With an API-first platform, Newline enables enterprises to launch and scale payment, card, and deposit products directly through Fifth Third Bank. No annoying or expensive middleware layers to go through, just a secure and direct relationship with Fifth Third Bank. Find out more about Newline by visiting newline53.com. Okay, so let's do one last story, and then if we have time, we'll wrap up with another thing. But I want to get to this one because it's important.
This is a very CFPB. Yeah, this is another CFPB
really
news item.
Go ahead, Kim.
I'll try to talk about it pretty quickly with the overview. There's some homework for everyone who wants to learn more about this. The CFPB has come out with 2 consent orders to financial institutions involving fintech partnerships. I am very interested in this, in part because as a bank reporter, I often focus on the prudential regulators, so the FDIC, OCC, Federal Reserve, and the state banking agencies. The CFPB is a consumer agency, consumer focused, and they can look at non-banks, they can look at financial institutions over 10 billion. And obviously, Director Chopra sits on the FDIC board and has spoken several times and mentioned the Synapse failures in his comments. So it strikes me as extremely interesting that the CFPB's consent orders on these bank fintech partnerships or the credit union fintech partnerships have come out. The first one is Goldman Sachs versus Apple on the Apple credit card program. And I think this one is significant because the because they got a fine from Apple. They deemed Apple to be a significant service provider to Goldman and found that Apple's decision-making, or what Apple wanted, led Goldman Sachs to basically like violate consumer protections in a variety of design ways. Maybe, most of them, and I'll say this, are not malicious, right? Like wanting to have, this like functionality about 0% interest, or wanting everyone to get their statement on the first of the month, right? These are not inherently mean or malicious choices, but they just meant certain things in reality and in practice that were being prioritized over other things. Obviously, I think people are really gleeful that like Goldman Sachs is like banned from issuing credit cards, and this partnership has cost Goldman Sachs in a variety of ways, and these millions of dollars in fines is just like one more thing to put a bow on this partnership. The other consent order is against ViStar Credit Union, which is a $14 billion credit union in Florida. In 2022, ViStar undergoes a online banking migration from their old provider to a new, more innovative provider. And this change goes horribly. Something that I think is really interesting is that what's the worst thing that can happen if you just lost access to your digital banking? And like, you would just like, you ever have like your app go out for like a day and you're like, okay, this is kind of annoying, but like your money still works, like your card still works, your money's still there, whatever. It didn't feel like it was going to be that bad, but apparently in this consent order, it was that bad. There were people who would call into the call center that wasn't staffed up for this outage, with facing 4-hour wait times. There were people who weren't able to do payments, I guess stuff wasn't on like auto pay, and so they received fees. They weren't able to maybe pay a credit card bill, right? Like you have to go in and like put money on the card. So there were fees there. And the consent order details ViStar's failure to manage this change and maybe some of the motivations and incentives around how this change happened, and what was like, speed was being prioritized, and they were receiving quality assurance concerns, and they reclassified all these issues as not urgent so they could launch the site. But I think it's really interesting because this is not a type of fintech partnership that really gets flagged as presenting problems for banks. But this is, and I would argue your digital banking provider is probably also a significant service provider. And Alex, I see here that you're making an argument that the investment that ViStar made into the digital banking provider maybe means that it's a BSC.
It has to be, right? Like, I mean, I'm sorry, but
thoughts.
Yeah, all right. So, okay, the Apple Goldman one I've covered a lot, and it was just a bad partnership, right? It didn't work. There's a reason that every other large credit card issuer that was like experienced in doing co-brand relationships looked at what Apple wanted and was like, hell no, keep me away from that. And Goldman was like, sign me up. This sounds great. So like, it was never going to work out great in that way. Some of the details from the CFPB's enforcement action are kind of damning, right? Like, for example, Goldman sort of had a sense that the billing and dispute management stuff that they were building wasn't ready, but they decided to rush it into production anyway because they wanted to avoid missing a deadline that would have allowed Apple to fine them, which apparently they thought was like a likely possibility if they missed it. So lots of rushing, lots of bad decisions. I think, Kiah, to your point, the one part of it that I find really interesting is that the CFPB specifically went after Apple separately from Goldman Sachs, which you don't tend to see a lot.
Yeah, I think that's bad. Like for fintechs
yeah,
who are like trying to really influence their bank partners, this is not a good sign for them.
There's a lot of stuff that goes on with the CFPB targeting Apple. First off, I mean, I think their argument is, as Kiah mentioned, their argument is that Apple was kind of driving the bus, and so as a result, they get it. But also,
not an untrue statement, right? Like Apple was exerting a lot of pressure on them, yeah.
But the other thing is that, remember from when Director Chopra was a commissioner at the Federal Trade Commission, he always went after big tech. Apple was always in his sidelines. They did a report. Was it last year? I don't remember if it was last year or not, but it was in the last little while about payment apps on mobile devices and how Apple freezes out everybody and doesn't let your bank to have a payment app on its app on the iPhone, and saying even Google on its Pixel, and as a proud Pixel user, I'm very glad that they allow this, but allows
all right,
your
green bubble.
Was that?
Oh, all right, green bubble.
I know, I'm the green bubble guy.
He's not in the text chat, Yep.
But you have your payment apps?
I do. But they allow, and he said Google allows this, and it's something that European Union has mentioned as well. Of course,
right.
Apple change, so.
Right. No, I think that's very fair, right? I mean, like it almost feels more like, oh goodness, we have an opportunity to go after Apple directly. This is great. We should take that. So I totally agree with that. I do think it does open the door for questions around like, hey, I'll just pick on Mercury because we've been doing that in this podcast a little bit, but like if you're exerting a lot of pressure on your bank partner because of the leverage you have in that relationship, which is different than the typical vendor relationship, that might open you up to direct action from regulators in the future. So it is a pretty interesting precedent in that way. On the ViStar thing, so we should say, based on the reporting that's been done, Nimbus would seem to be the name of the vendor in question,
who was not part of the consent. I mean, did not receive a consent order. Yeah,
and was not named in the consent order. So that's based on reporting separate from the consent order. But the thing I find interesting, Kiah, going back to your point, is ViStar invested $20 million in Nimbus, right? And this is not uncommon these days, right? Like banks invest in fintech companies. Kiah, when you mentioned way long time ago in this conversation that the OCC has the theoretical capability to subject to supervision service providers where the bank has a non-controlling interest. I was also thinking about like Wells Fargo investing in Built as another example of that potentially. So like you do see banks invest in vendors or in fintech companies that they partner with. So this is like a model that does exist in various forms today. Wasn't that the original purpose of the Bank Service Company Act? Like it was literally like banks pooling their resources to invest in technology that they could then use, but then also, I guess, would make some profit off of as a part of that investment. So the fact that they do have that investment, I think clearly qualifies Nimbus as a Bank Service Company Act in my unsophisticated non-legal reading of things. And then the other thing with the ViStar stuff that I just would flag as a thing for anyone who works at a sufficiently large bank or credit union, make sure you're on the record about what you think as it relates to selecting vendors and launching stuff, because that was the other thing in the consent order that really jumped out to me was the CFPB was flagging, they went through an RFI process and an RFP process, and then management overruled the selection of a different vendor and decided to go with Nimbus, possibly because they were invested in them. Yeah. They went through a whole QA and testing process that wasn't really done in a rigorous fashion, and it turned up all kinds of issues. And then management decided to declassify all of those issues as red flags and just keep forward and pushing with the project. I think it even said that the folks who QA'd the launch said it wasn't ready and that it would create reputational issues for ViStar if they went ahead with the launch, and they were ignored, right? So the QA person at ViStar looks great coming out of this, but I think it's just really interesting that there's a level of scrutiny being applied to vendor selection, migration of tech, the process that goes into launching tech, and all of those things are now things that are sort of, I guess, on the table for things you could end up being liable for if it impacts end consumers.
Yeah, and I think it is interesting that the CFPB gave these consent orders. We have seen lots and lots and lots of examples of consent orders issued by the prudential regulators that do touch on third-party risk management, that do touch on vendor selection, that do touch on risk appetites and documentation. And I think the in here of the consumers being impacted gave that's just super important to the CFPB's ability to get in here, right? Like the CFPB has to prove probably consumer harm in a way that the bank regulators don't. And it is really interesting that the NCUA worked with the CFPB on the ViStar investigation, but did not put their own consent order out, and that we don't have a similar consent order from like the Federal Reserve or the OCC or the New York DFS DFS. I don't know which one Goldman Sachs Bank is supervised by. And also, like, I'm kind of disappointed because I do want this from bank regulators. I do think there's a role that bank regulators could play here. I think this violates, safety and soundness or reputation risk or whatever they say that they're interested in. So I am confused about the capitulation, but it's interesting to see the CFPB enter the chat on this.
Yeah, Evan, go ahead.
I mean, the Goldman Sachs Apple penalties are not really all. I mean, it's a lot of money. I don't remember, but it was like over. It's
like 90 million total.
Yeah, it's like around 100 million.
Yeah.
That's not that much in the grand scheme of things for those two companies.
Vistar's only 1.5 million.
Yeah, well, I mean,
I think it's small. It's $14 billion institution.
Yeah. Well, I mean, the CFPB, the CFPB cares very much about people being able to get access to their money, and particularly since Synapse, since they can't really do anything about Synapse because it's not a consumer finance fintech, and the banks are really small. They're below the $10 billion level. So this is their way of saying,
hard to get to.
It is their way of saying, in part, if you stop people from accessing their money, we are going to come after you. And we have UDAP authority, which is unfair, deceptive, or abusive acts and practices, which is different than like traditional UDAP, which doesn't have abusive in it, which under an aggressive CFPB director can be wielded in very, very many different and I like to say magical ways, because anything can be a UDAP if you try.
Evan, can you remind me? So in both of these instances, they're over 10 billion and the CFPB does have direct oversight authority. I was actually under the impression the CFPB can determine oversight authority is appropriate for institutions under 10 billion.
They have something, I mean, they one thing that Director Chopra did when he signed up was that he started using old powers that weren't really used before. He calls them dormant authorities. He said that about open banking, dormant authority. And one of them that he did was that if the CFPB determines that you are a risky institution, even if you are not technically regulated by the CFPB, they can designate you for supervision. And they did that with some fintechs, big ones. They can't say who, but there were several that were designated, and the fintechs also can't report that. This is all
confidential supervisory information.
Yeah.
Come on.
There it
so
is.
Theoretically, I guess they could for some of the smaller banks, but they wouldn't necessarily be on the CFPB's radar in the same way that some of the bigger companies would be. They wouldn't. Theoretically, the Arkansas banking regulator could call the CFPB and say, "We've got some stuff going on with Evolve over here." And despite everything, red state regulators work with the CFPB on a lot of stuff, and red state attorneys general work with the CFPB on a fair amount of stuff. So that wouldn't have been out of the question. But unless they have a way of knowing about this, they probably have a way.
I will say Evolve, it's really important to mention that there is a bankruptcy proceeding, so it is entirely normal that the money stopped moving. But I do think it's important that everyone thinks about access to money as being the same thing as having the money. And it is not super defensible to say, well, your money was available and you could have just called us and waited for 4 hours and we could run that for you. That's just not reasonable.
Or go to the branch that's really inconvenient to get to or whatever. Yeah.
It's just like, these are not winning arguments, even though they are technically correct. And they're not going to save you from the consent order.
Well, I think, go ahead, Evan.
It's not even the first time that they've done something. Remember the rush card incident from a long time ago where people were locked out of their accounts, and the CFPB under Richard Cordray went after rush card.
Yeah, no, that's exactly right. I mean, it's the access to money and impact on end consumers, given the magical abilities under UDAP, I think is the right way to think about it. But again, to your point, Kiah, it's not something that anyone can make a really good substantive argument against. It might seem a little unfair, and there is a devil's advocate position I have on these consent orders, which is it seems a little bit like you're just sort of picking on things to make a point, but it's also a good point to make, and these companies did screw these things up. So I think it is, at the end of the day, fair. All right, before I let you go, we do have a little bit of time, and so I'm going to make you guys do this. All right, you ready? So we're going to play a little game because we've been talking all about the CFPB. Obviously, the election happened yesterday. The CFPB, I think, is probably the best example of a federal regulatory agency that can swing pretty wildly administration to administration, just because it doesn't have a long history. It has a pretty broad charter. It has some of these magical abilities that can use or not. So we probably should expect, I think, some pretty significant changes moving forward. So to sort of commemorate where we are right now, and then hopefully set us up for conversations in the future about where we're going, I would like to hold a CFPB draft. So the rules of my silly game are, I'm going to make each one of you pick, and we're going to go through 3 rounds of this, just anything from the history of the CFPB that is one of your favorite things they've done. And I put favorites in air quotes because you can define that however you want. It can be interesting to report on. It can be a novel example of how they've used their authority. It can be just something that you found amusing and enjoyed learning about. But whatever the thing is, I asked you each to prepare a list that you would like to draft. And Evan, as our guest, I'm going to give you the first pick in our CFPB draft. So give us one thing that you would take first on your list.
Okay, I am going to go first, and I'm going to pick the CFPB citing Clarence Thomas very favorably in their briefs regarding the venue selection in a lawsuit over its credit card late fee rule. Clarence Thomas has some issues with the idea of associational standing and bringing lawsuits, and the CFPB is basically saying, we don't think that this lawsuit should be in Texas because there is no bank in Texas that would be subject to our credit card late fee rule, which the judge has tried to send back to Washington.
Yeah, it's gone back and forth, right? And the judge keeps trying to steal it.
No, the court in Washington really wanted it.
Yeah.
But the Fifth Circuit really wanted it to stay.
Yeah, they're like tug-of-warring it.
Yeah.
Interesting.
But so I'm just enjoying, after Clarence Thomas wrote the opinion allowing the CFPB's funding to survive in the last Supreme Court term, how now they've turned to Clarence Thomas to help defend their venue location choice in the late fee suit. It's very much the clickhole, heartbreaking, the worst person you know just made a great point meme come to life.
Okay, that is a great one. Also, as someone who works for Bloomberg Law, that's a very appropriate pick for you. So well done. All right, that is your first pick. Kiah, give me your first pick.
Okay, so one of my favorite things the CFPB has done was the very brief change in name from the CFPB to the BCFP under Mulvaney, acting director Mulvaney, who was the, I can't remember the circumstances under which Richard Cordray leaves the CFPB, and Mick Mulvaney comes in. It was so delightful that he made this his first order. One of the most important things they did, they were ordering new signage. And then when Kathy Kranziger comes in as the confirmed director, she immediately is no, we're going back to CFPB. And so I would, of all the things that could come out of a Trump financial regulatory agency, I would love to see us bring that back. I think retro stuff is in right now. And so, anyways, I'm sorry. This was not serious. No. Everyone needs to be reminded of this hit, this banger.
Well, first of all, this is a deeply unserious exercise, so that's totally fine. I'm jealous of that pick. And I will say the thing I would want is merch. Are there t-shirts? Did they have t-shirts made? There were signs, but they had a flag.
Hey, if you have BCFP merch, find me on November 18th, 19th.
Yes.
Give it to me. I wear a women's medium.
I don't have merch. Can I just say, Cordray's departure was my least favorite thing that the CFPB ever did. Oh. Not for anything about Richard Cordray. He left to run for governor of Ohio.
That's right. Did
not win, but it came on Thanksgiving weekend. And it ruined the Thanksgiving weekend that year. It was brutal.
Oh, I remember Richard Cordray looked like this guy from 30 Rock, and people would sometimes switch out the photos of the it's like the assistant in 30 Rock who's kind of religious and clueless. It's a very funny character. What?
He's a Jeopardy champion.
Oh yeah. Uh-huh. So there was this whole thing. That was another great thing about the CFPB was the Richard Cordray 30 Rock guy lookalike. That's not my second draft pick.
No. That's fair. That's fair. Yeah, I won't steal that one. All right. So, my pick is mine's a more recent one, but I don't think it ever really went anywhere, and probably now it won't. But remember when the CFPB got kind of wound up about like credit card shopping apps and like price comparison tools, and briefly mentioned at the bottom of their sort of comment about it that they were going to launch their own competitive price shopping tool based on survey data they do of all of the credit card issuers. That is my number one pick because
why?
Because it is the most like wild thing to just sort of toss in there and go, we're going to do this thing. Like that is so not what you do. There's absolutely no way that consumers would ever use it. It kind of is like, it's a version of the, like Kiah, when the FDIC does the consumer facing newsletters and you're like, but no consumers read this. Like the whenever,
you don't think they all took the quiz to figure out if they know about deposit insurance?
I know. I really,
shocked.
I don't, although I did find that amusing. I mean, it's just like whenever regulators, and the CFPB has more of a right to do this, I think, because they're more consumer facing than others, but like whenever regulators sort of overestimate the role they can play in kind of like a B2C kind of context, that just always deeply amuses me. So I'm taking CFPB credit card price comparison as my first one. All
Evan?
right. Evan,
Okay.
what's yours?
I am going to go back to when Richard Cordray left because that gave us the war for the CFPB succession when there was Mick Mulvaney, that now President-elect Trump, chose to be the acting director, and then there was Leandra English, who was a top deputy to Richard Cordray, and they both claimed to be the CFPB acting director.
Oh, I remember that.
That was wild.
Yeah, and it went to court, and I kept asking, Leandra English is a government official. She doesn't have a lot of money. I kept being like, hey, who's paying for this?
Did you ever figure it out?
No, nobody told me. I knew the lawyers too, but they wouldn't tell me.
That's a good
might have been pro bono. It's possible it was pro bono because the lawyer representing her is a guy named Deepak Gupta, who is a former CFPB person who was there from the very beginning, now runs a very successful consumer appellate law firm. So he might have done it pro bono. That's certainly possible, but it was just the wildest, weirdest, kind of pointless thing.
That was weird. That was really weird.
And really like pointless because you knew that it was just a holding action because like Trump was going to appoint a director and that director would get confirmed.
It was almost, I mean, it didn't quite get to this level, but it was, if I'm remembering right, it was almost like, I'm going to lock the doors and not let you in. I mean, it was like descending to like childish levels in a weird way. It was a very strange time.
Oh, they had to make her an office and all sorts of stuff.
Yeah. Okay, that's a great pick. And I can't believe you got that with your second pick. That's a really good one. Okay, Kiah, give us your second pick.
This is a new action, and I definitely have recency bias, but as someone who has student loans more than 10 years out of being from college, I love that they banned Navient from federal student loan servicing. I think, this is my opinion. It's all my opinion. This is extra my opinion. Student lending is so opaque and repayment is so like archaic. It's so difficult. The options are so weird. It's weird how like the capitalized interest means that you can make payments on your loan for years and never really meaningfully pay it back. I was extremely disappointed by the Supreme Court in overturning the federal student loan forgiveness. And all that is to say that it just kind of seems like borrowers get the short stick sometimes on these, and that there's so little legal recourse around practices that are abusive. And Navient sounds like they were not that good at their core job, which is helping people service their loans and putting them into repayment structures that would be good for the borrower. And that I love that CFPB looked into this and was like, you are so incompetent and self-interested, it qualifies as abusive, and we will not let you do your core job anymore. And so I don't know what that means long-term for Navient. I don't care about it because I still have student loans that I'm paying back to someone. And at the end, in 11 months, someone better send me a letter that's like, you paid it off. And we know you paid it off because we're good at keeping our books and records.
Navient basically got out of the federal student loan.
Yeah, this was the FELP program, is like the FFELP Which is also like, that was a family plan. Those were like parents paying their student loans.
I know. No, they got out a lot of this business by the time the consent order came because of litigation. I mean, that was launched under Cordray, kept going under Trump.
But imagine just like, this is your core job. Like you're like bad at, like if a bank was this bad at it, right? And these are financial institutions, right? They're loaning money. I think does one of them has an ILC? Like one of them has a bank. One of the student lenders has an ILC.
I don't know which one it is.
I didn't mean to give everyone a quiz. I'll look it up while Alex is talking.
Yeah.
No, I don't remember that one. I will say on the servicing front, I've gotten more passionate about mortgage servicing than student loan servicing. But like servicing as a general rule is like you have one job to do. Please don't screw it up. And so I'm with you on like if you're not good at like the one thing, you shouldn't just be allowed to be in business. So I do like that one. I also do like just generally the CFPB like just sort of banning, but like in quotes, because it's always conditional on some other thing, like your ability to do this. We mentioned earlier them banning Goldman Sachs from launching a consumer credit card, which all the partners at Goldman Sachs were like applauding wildly when they saw that, I'm sure. So
no, Goldman Sachs had already said they weren't doing that anymore. Anyway.
No, they want to be out of that business. Like that's the worst business for them ever. So they're like, please ban us from it. We never want to be allowed to go back into that again.
Us do it?
Right. They're like, don't
Nelnet
threaten me with a
has
good time.
the ILC.
Yeah.
Nelnet. Okay, got it. All right. My second one is going to be the RFI that Chopra's CFPB put out on customer service and relationship banking. Do you remember this one? This was the reason it's stuck in my brain is that Director Chopra actually came to Great Falls, Montana, which is one of the worst places on earth to talk about this. But it was such an interesting sort of effort to talk about. It's essentially like an anti-big bank talking point where we don't want consumers to get trapped in these endless loops of trying to get a human being on the phone, but sort of juxtaposed with this sort of like 1940s style pining for the days of relationship banking and It's a Wonderful Life. And it was a very strange way to talk about it because, as we've been talking about, a lot of the things that the CFPB is doing or has done haven't necessarily been to the benefit of small banks or have necessarily like had small banks' interests in mind. But at this particular moment, they were very like, small banks are the backbone of our economy. Relationship banking is critical to making sure consumers get things. It's important for people to still go into the branch and be able to talk to a human being on the phone. And digital is kind of evil. So maybe it sort of presaged where we were going with some of the ViStar stuff, but it was this ode to relationship banking always stuck in my brain as like a very odd thing that I just enjoyed reading about.
All right, Evan, third pick.
My third pick.
Final.
I'm going to go. I'm going to cheat. I'm going to do my third pick and a third and a half pick. My third pick is. I don't know how much you guys FOIA federal agencies, but it stinks. And
yeah, not as much as I should.
Kathy Kreiniger, to her credit, when she came in, she said, I am going to make the CFPB FOIA office better. And she did. It was still like not as fast as you would want, but she made it better. And so kudos to her for following through on that. 3.5 is the first. So I started covering the CFPB in 2012. That's when I started covering banking in general. And I very much recall the first time I saw Richard Cordray at a major conference. It was at the Clearinghouse Conference in New York. Came up there, basically gave the Festivus speech, aired his grievances at assembled bankers. And I don't know how often you've heard him speak, but he's a very soft-spoken kind of guy.
Yeah.
In his very soft-spoken way, just got up there, gave him the business, said, I got a lot of problems with you people, and you're going to hear about it, and we're coming for you. And I loved it.
It's like the regulators, I'm not here to make friends.
Yeah.
Kind of.
That is a good one. That's a very good one. I wish I could go back in time and watch that one because it is, again, kind of going to this idea like that CFPB is just a different animal. They just have a way more like antagonistic relationship with industry, right? On both sides, right? Like industry is antagonistic with them.
Again, the regulation by activity, not by charter.
It's a market regulator, not a prudential regulators, more like the SEC, which has this kind of antagonistic relationship as well.
Yeah, it's by design, right? So no, it's I think that's exactly right. All right, that is a good. Well, you cheated a little bit, but we'll allow it since you're the guest. All right, Kiah, give us your third one.
This is a pan. This is a hard pan. This is, I guess, maybe something that I hope Trump CFPB director will drop, which is the airline reward miles interest and the credit card partnerships.
Damn it! I had that one on my list. I had it on my list, Kiah. You
Alex,
stole
it's
it
on the
from
outline.
me.
You can see what I was going to pick. I have a dog in this fight. Like, the CFPB, if they do this, will make my life worse. I would like to log that as a comment letter. And I would also like to log that this is a fake economy. This is a fake market. This is fake money. The miles are fake. The miles are just a mere program that is designed to increase loyalty, to reward small modicums of loyalty, to change my behavior. I, as an economic actor, get to decide what credit cards I use. And it's kind of like, I actually kind of think that if you believe these products and programs are abusive, it is because you as a consumer have failed to do your due diligence to understand the rules of this market. And I say this as someone who helps people use their credit cards.
It's true.
In
you
a
can
way
call Kiah
that helps
any day
them.
Or night.
Yeah, that helps them get their value of this. And I don't think it's on the banks or the airline companies to explain the market. The people who, you do not have to take the fake money. You do not have to take the credit card. And so when you are confused by the rules of this market, which, by the way, inflation happens in this world a lot more than inflation happens in our real world, that's not abusive. When your miles go away and they expire because you didn't do activity for 12 to 24 months, that's kind of on you. And I don't think the CFPB needs to really get involved here. And I think if the CFPB did get involved here, the programs would get worse because whatever harm the CFPB thinks is happening, the airlines will be like, I just don't have to give you this thing for free. And so I don't know, is Chopra buying all of his flights? I don't know. Do they not spy reward miles? What?
So my theory, and I might be totally off base, but my theory is that someone in Congress had something happen to their miles and got pissed about it and made some calls, because it just popped up on the priority list out of nowhere, and it didn't ever really seem to go too far. I don't know that much has happened since.
Maybe it's a senator from Illinois.
Yeah. I mean, the whole other thing too, and whole other thing is this is a byproduct of Durbin. Why are you arguing with the world your dumb law created? And there's so many things that we talk about this with fintechs, right? We're talking about all these problems that come out of Durbin. Go fix the thing that created the problem. Go fix the root, or understand this is the fruit of the tree that Durbin planted. That came from the seed of Durbin.
Wow.
Are you Richard Hunt?
I mean, anytime we can get Kiah to rant a little bit about leaving credit card rewards alone, I think
just leave my rewards alone. Just let me pick up my little pennies, okay? Let me get my little swipes, my little pennies from my 13 credit cards. This is my unique hell that I live in, and you can stay out of it. You don't have to play in the space.
Kiah loves optimizing her credit card points. All right, my third one to round us out, and I'll stay with my trend of more recent stuff, is kind of, Evan, based on your 3.5 one. I really enjoyed the game of chicken that Director Chopra played with the financial data exchange over standards for open banking that's been going on for the last couple of years, and crested in person when I saw him speak at the FTX conference, where same thing as what you're saying with Cordray. He got up and gave him the business and had no problem being it was like watching a wrestling heel, and wrestling just soak in the booze and the hatred on stage. It was very impressive to watch. I have no idea how all that's going to get scrambled by the election and the change in leadership at the CFPB, but it was fun while it lasted.
I have a lot to say about the FTX stuff, but I don't think we have time for it.
Well, we'll save it. We'll save it for the next podcast, Evan. We will have you back. Kiah and I are both looking forward to getting to see you in person in a couple of weeks, and thank you for joining us for Bank Nerd Corner. This was fun.
Thanks for having me. It was a lot of fun.
See you guys in a couple of weeks.
All right. Bye, guys. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.